All right, good morning, everyone. Thank you for joining us. We appreciate you being here. Laura Hepkessel, I am actually with SIU School of Medicine on my day job, but I'm here representing Real Partners as immediate past chair. We want to first welcome everyone for being here. I would like to thank University of Illinois Extension for partnering with Real Partners to offer this webinar series. We have been doing this for the last 2 or 3 years now, and we really appreciate this partnership, and we try to bring great topics to folks in rural Illinois that are interested in the same things we are. So today we're going to hear from a couple of county treasurers, and we'll talk about the Illinois County Finance and Investments webinar, Illinois County Finance and Investments in this webinar. But first, I just want to tell you a little bit about Rural Partners. We are the state's Rural Development Council. We're a volunteer working board. We've got some great folks involved with the organization. We're always looking for more members. If anyone's interested, I'll put a link to our website in the chat so you can check us out, and feel free to reach out if you have any questions or would like more information. Again, Rural Partners is thankful for the partnership with University of Illinois Extension and offering this webinar series. We're so thankful today to have Staci Mayall, who is the Fulton County Treasurer, and Chris Slusser, who is the Madison County Treasurer, with us. And they're going to talk to us again about Illinois County finance and investments from a county treasurer perspective. So I'm going to pass it over to them. If you have questions throughout their presentation, please include those in the chat box. I'll be tracking those, and we'll get to the questions at the end. We should have plenty of time for their presentation and then again to answer those questions. So Staci and Chris, thanks again, and I'm going to pass it over to you.
All right. Thank you, Laura. Thank you for everyone who's on today. I hope this is going to be helpful. We're going to share some of our ideas and our strategies that have worked well for us that hopefully everyone can take back and use in their own county or city or wherever you're located. So I've been the treasurer for almost 7 years now. And when I took over, one of the things I noticed was our county's investment portfolio was drastically underperforming. It wasn't being managed well. And I learned that actually is pretty common in government finance, whether you're a big county or a smaller county. It's just something that a lot of treasurers don't have a lot of expertise or background in. And they're busy doing a million other things, and trying to manage investments is usually not at the top of the list. But for me, I had an investment background. I spent 8.5 years as a registered investment advisor. And so this was something that I kind of, embraced and took over. And we've done really well. And I'll get into some of that. But first, I want to talk about, for you at your municipality or your county, how you can transform your investments to maximize them and get the most benefit out of them, and why that's important. So go to the first slide here. So what do you really want to achieve with your reserve funds or your special revenue funds? What do you want out of your investments? Is it something that you want? Would you like to build income from that via interest to supplement your budget? Or is it something you just want to park there and forget about? Or is it something you just want to be hands off on? You want it to do well, but you don't want to be the one actively involved. But I think at the beginning, you have to ask, what do you really want? And once you do that, then you can start to develop a plan. And I always say a goal without a plan is just a wish. So if you, because a lot of times we sit around and we talk about the things that we would like to have happen. Man, I'd really like to do this. I'd like to do that. I'd like to go on this vacation somewhere. I'd like to buy this, but we don't put a plan in place to do that. And if you don't do that, then it's a wish. And the same thing with your investments in your county or your city. And so when you start to develop a plan, you can decide, okay, the first thing I do anyway, is I conduct a cash flow analysis. So of all the money we have in reserves and the money we have coming in and money going out, what percentage of your funds do you need in the next 3 months, 6 months, 1 year, 2 years, 3 years, 5 years, etc. Because if it's money that you're going to need very soon, then you want to keep that money more liquid, obviously, because you don't want to have to sell off an investment or a CD prior to it maturing. And so when you do a cash flow analysis like this, and you can kind of benchmark where some of the big ticket items are going to be, or at what point of the year do you spend more money, then you can plan out your investments and have a little more effective plan from a very basic level. So then you have to decide how hands-on you'd like to be. So I have my plan on how I'm going to spend the money and how my cash flow analysis and when I'm going to need the money. But then what do I do with it? So do you want to do it yourself? Like and I don't do all of ours myself. I do a lot of it, but I don't do 100% of I don't manage it all on my own. Or do you want to hire a professional? Do you want to hire a firm that can manage that for you? So the do-it-yourself options, I'm going to keep it on a simple level here. I won't get too far into the weeds, but if you want to keep it simple, you can keep it with local banks and money market accounts or certificates of deposit. And money market accounts, for those of you who don't know exactly what those are, it's just basically like a checking account that pays interest. And usually you can access that money fairly regularly. Some banks may put some limits on how often you can access it in a month, but for the most part, we're able to access our money market accounts whenever we need the money. And it's typically going to pay more than your operating account is like your checking account. Usually they're not going to pay you much interest at all on those. But if you have money in a money market, that's money that you're not necessarily using on a daily basis. So they're willing to pay you more interest. And right now, if you're not getting 4% interest on your money market account from your bank, then you need to have conversations with your bank because they're all the ones who are competitive and want your money and want your deposits are going to pay that. Certificates of deposit, CDs, those are pretty simple too. You just determine what length you want your maturity for your CD and you park the money there. And local banks for the last 14, 15 months have been very aggressive at seeking those deposits because all their liquidity dried up after all the COVID money and the ARPA money and the stimulus money kind of dried up. And so they did not want our money at one point, or they didn't want to pay us anything for that money. Now they're very aggressive and they want the money because they're needing deposits. So you can put those out for bid, a certain amount of money out for bid, and they're going to be pretty aggressive if you shop it with enough banks. Government pools, that's another area where some of you probably have money. Illinois funds is the most common one that counties would have. PFM is another one. IMET, which is Illinois Municipal Investment Fund. They all have pools where they pool the money together. It's similar to a money market account. That money is liquid next day if you need the money. They're all paying very handsome rates right now, anywhere between 4.85 and 5.5%. And that's money that's liquid. Like I said, you can access it next day. So that's a very attractive option now. Now, parking all your money there, though, the risk you run is if rates do fall again, all your interest rates are going to fall as well, versus money you might have tied up longer term somewhere else. You're going to continue to get the higher interest rate. So that's keeping it simple. If you're doing it at a very basic level, you can't really screw it up by doing that. And it's effective when rates are good. When rates start, bouncing around or going up and down, sometimes you want to be a little more creative. And that's what I did. And so you can purchase treasury bonds, brokered CDs. They're up to the FDIC amount, federal agency bonds, which are like Freddie Mac, Fannie Mae, federal home credit bonds or farm credit, municipal bonds, which would be, you can buy pretty much any municipal bond in America that you want to buy, as long as it's rated as investment grade. And corporate bonds. Corporate bonds, those are more restricted. They have to be one of the 2 or 3 highest ratings, and we're not allowed to purchase a corporate bond with a maturity out more than 3 years, just because there's a little more risk involved with those. So, but all of these things, they fall under the Public Funds Investment Act. And that's in statute. It gives us our guidelines on what we're allowed to invest in. So we're not allowed to go invest in equities or stocks or mutual funds, gold, anything like that that's going to have a lot of speculative risk. And so they kind of tie our hands a little bit for good reason, because this is public money. But and there are guidelines, like I said, with the corporate bonds on how far out you can go with a corporate bond. But these are just some ideas. So if I got too far into the weeds there on getting a little more creative, maybe that means that you need to keep it more simple or farm that out. So if you hire a professional, So you send out a request for proposal. And if anyone would want anything like that, I have examples of RFPs that we've sent out for investment firms. And so you may get anywhere between 3 and 10 firms respond that they're willing to manage your money. And then you go through a selection process. And most of them are going to come in fairly similar. Some are going to have fees that are pretty high, and you're not going to want to use those firms because it's just going to be too cost prohibitive. But they will charge you a percentage fee based on the amount of your investments. And most of them are charging 12 basis points, which is 0.012%. That's kind of the going rate. Anything higher than that means you're probably paying too much. So I always make my selection based on, number one, someone you can trust, because this is someone who you have to trust with your county or your city's money. They have to be someone you enjoy working with and you look forward to working with, because you're building a long-term relationship and you're putting a lot of trust in these people. And like I said, the reasonable fees. So because with bonds, prior to these interest rates going back up to, 20-year highs or 30-year highs, bonds there for a few years were only paying, 1 or 2% interest. So if someone's charging you, 0.3% or 0.4%, well, that's eating into a lot of your profit there, so that's why with bond investments, typically those fees should be right around 0.12% to 0.15%, somewhere around there. All right, so we're going to talk a little bit about what we did in Madison County with our investments. We are a bigger county, so I think we're probably 7th or 8th largest county, about 264,000 in population. And when we talk about this, all of us in the County Treasurers Association, we all know that all treasurers are not created equal. Not that we're all not good at our jobs and great, but we all have different roles that we perform based on the size of our county or just the way our county is set up, or our county governance. So, because of the size of our county, we have a county auditor who's not someone we hire on the outside. It's an elected auditor, and they actually serve as our chief financial officer. So all the payables actually go through their office. That doesn't come to my office. They also do all the fund accounting, which a lot of treasurers like Staci has to do. She does the fund accounting. So that's an extra layer that she has piled upon her. Some treasurers do payroll, some don't. So my county, we don't do, the treasurer's office does not handle payroll, and we don't handle fund accounting. So it's kind of a dream job for being a treasurer, because those are two things that can be big headaches and a lot of work. But this allowed me to focus a lot on investments. So where we started, December 31st, 2017, this is what our portfolio looked like back then. We had $149 million, which is a lot of money. Most of it was tied up in CDs that were paying very, very low interest rates, money market accounts that were paying very low interest rates, federal agency bonds that were paying very low interest rates, and municipal bonds that there were only 4% there, and they were paying halfway decent interest rates. So if you look at this next slide, this is what the rate of return, the yield was on these investments. So the money market accounts were paying 0.41%. The CDs on average were paying 1.05, agency bonds 1.14. And so it was not very exciting. If you look at that, if you looked at that in your 401k, you'd be, wow, this is pretty lame. We're not even keeping up with with inflation. And that's what I thought when I looked at these as well. And so if we're not keeping up with inflation, you're actually technically losing money, because you're losing purchasing power on an annual basis. So we started overhauling it, and we did an analysis. So what we noticed was, number one, safety requirements for public funds investing were being met. It was very, very safe, too safe, actually. Liquidity needs were being met. So there was plenty of liquid money to pay the bills and meet large ticket item expenditures. Yield opportunities were being missed, however. As I mentioned, there was a lack of diversification. There was too much exposure to inflationary risk. So, inflation was 2.2% or 2.5% at the time, and we were earning 1%. So we were losing purchasing power, and we were exposed to inflationary risk. We were getting below market rates on money market accounts, and the portfolio was being passively managed versus actively managed. And when I say passively managed, basically they were investing money, just parking it somewhere and forgetting about it. And then when those investments matured, then they would just park it somewhere else and forget about it. When you're actively managing it, you're constantly looking for opportunities to invest, and you're not just taking $20 million and parking it in one investment. Most of the investments I do are $500,000 at a time, and we have a lot of them. So we'll get to in just a minute. So we had to develop a strategy. And one of my favorite quotes is from Zig Ziglar: if you aim at nothing, you'll hit it every time. And that is so true in life and everything you think about. So we had to have a strategy. What are we looking for? So what we did was we built a very simple bond laddering strategy. And this is, I get a lot of credit for our investments doing really well, but honestly, it's not rocket science. I keep it this is a very, very simple strategy. Investment advisors that I talk to even laugh at how simple the strategy is, but it works. Investing doesn't have to be that complicated. So what we did is we had buckets of money. So we had money that matures in 1 year, 2 years, 3 years, 4 years, 5 years, and so on. And we would just park money in each one of those maturity levels. And then when the money matures, then you take those proceeds. If you don't need the money at the time, then you go back and you put it up at the top of your ladder, and it just comes on down. When you do that, you're not trying to time the market, and you're not really interested in what interest rates are at the time. I'm going to stick to a disciplined strategy. Sometimes rates are going to be high, sometimes they're going to be lower, but on average, we're going to do well, and we're going to be consistent, and we'll have some predictability with the income that comes from the portfolio. So we diversified the portfolio as well. So you never want to put all your eggs in one basket. And that's kind of what we were seeing when we took over the portfolio. So we started investing a lot more in municipal bonds because there was a lot more yield opportunity there. We added some corporate bonds. We added U.S. Treasury bonds, government pools, IMET and PFM. We added those to the mix. We diversified our money market accounts. We always negotiate new rates. Excuse me. So for the past year, interest rates, past, I guess, 17 months, interest rates have skyrocketed. They were too low for too long. The Federal Reserve waited too long to start raising rates. And once they finally did, banks realized they had to start paying interest on these accounts that they were paying you almost nothing on. And so, but if you don't call a bank, as those rates continue to go up, the Federal Reserve, they're making more money because they're getting what the Fed rate is. And then they pay you the interest, and then they make the difference. So right now the rates are 5.5%, they're getting 5.5%. And if they're only paying you 1%, that means they're making 4.5% on that money. Now they're not a charity operation, so they are there to make money, and they have shareholders. But we also, as treasurers, we have a responsibility to the taxpayers to get the most bang for our buck as well, and their buck. And so I call these banks regularly. I'm like, hey, our rates are 3%. We need to bump this up over 4%. They're never going to pay you exactly what the feds are paying, but they should be within 1% of what the Federal Reserve rate is. So we also had added an additional money manager. We sent out an RFP, we interviewed firms, and there's a firm from Lake County that we use, some really, really smart guys, and they're doing a fantastic job. And they're doing some investing that's a little over my head, and I just don't want to take the time to monitor. And, I still have other duties I have to do as treasurer. So it's a little more sophisticated stuff that they do. All right. So then we do regular cash flow analyses here. So here I collaborate with our county auditor, who is a good friend and a really smart CPA. And we run analyses like, okay, these times of the year are when we're going to need more money outflowing. And if you're a county treasurer right now, you know that, our fiscal year is coming up on its end, and people are spending their budgets down. They have money left over. They're afraid they're going to lose it, so they're going to spend it. And so we have a little bit more outflow right now than normal. We have a flood prevention district here that we collect a sales tax, a quarter-cent sales tax, and they have about $28 million in that fund right now, repairing it because we're right on the Mississippi River. And so they're getting our levees up to 500-year levels because they were about to be decertified about 15 years ago. And so that money continues to accumulate. Well, they told me, hey, we're going to need in April of 2024, we're going to need half of that money. So we're going to need $14 million. So I make sure that I have enough money in cash, and I have other investments that are going to mature right before that happens. So I'll have plenty of money to send that $14 million to them. And then still pay all of our bills and, not have to sell off investments in order to meet our cash flow needs. We also have an ARPA administrator here because we got like $51 million in ARPA money, which is a lot. And so we actually hired an administrator who's going to be here on a temporary basis to help administer that. And we hired Ernst & Young as a consultant. So I'm constantly, they've surprised me a couple of times where they've spent ARPA money without giving me a heads up, and it's some big ticket items. And so I'm constantly in contact with them to make sure that we're on the same page. So we determine the cash flow needs based on previous years and project future needs. So this allows us to determine the appropriate amount of liquidity in our portfolio. So managing it, I use 3 separate brokers that I buy bonds from, which ensures competitive bidding. And these brokers are 3 brokers that I enjoy working with. They know exactly what I'm looking for. They don't send me things that I don't want or that are not permissible under the Public Funds Investment Act, like a bond that's not rated high enough. That's happened before. I've had to fire some brokers because they kept mistakenly sending me, mistakenly, air quotes, junk bonds. They're non-investment grade. And so I got rid of those brokers and I used the 3 that I can work well with. And they keep it very simple. They are very good at educating. They don't talk over your head, and they make life easier for me. We added North Shore Private Asset Management, which is a firm out of Lake County, to manage a share of the portfolio. I know some other counties are using them as well. So we actively manage the portfolio, allows us to identify opportunities to unload less desirable investments when there's an opportunity to improve yield, allows us to constantly find bargains in the marketplace, and regular portfolio reviews, both in-house and with the 2 investment firms. One's a broker and one is the firm that helps manage our money. So that way it's not just me in a bubble thinking I've got it all figured out. I always, I'm a firm believer that I don't have the market cornered on all the good ideas. And so I like to collaborate with other experts to make sure that we're always doing things well. It's good for my accountability, so I don't get too tunnel vision or pigeonholed. So this is what we look like now. I showed you that one earlier was very limited. Now we have a very, very diverse portfolio with a lot of different types of investments. And we're performing very well. And I'll get to that here. So these are the maturities. So, and this is about a month, these numbers are about a month old, but so you can see 2023, we're coming to an end of the year. So we're going to eventually have 0 there. And then we have 42 million maturing next year and then on down the line. You see kind of how we set up that ladder. So we constantly have money that's rolling over. The good thing is the money that I've gone out as far as 2029 and 2030, that's money I know we're not going to need because we have enough liquidity, to meet our liquidity need. We're earning like 6% interest on some of those investments right now. And if the market, if interest rates go down, let's just say they went back to 0 next year because of some kind of, recession or a financial crisis, I still have 6% interest locked in on some of these investments for like 7 years. And so we're going to continue to bring in a lot of money, even if interest rates were to go down. So that way we're protected against, a crazy interest rate environment. So here's 2016 on the left, what I inherited, and here's where we're at now. Drastic difference. We had 9 municipal bonds. Now we have 431. 6 agency bonds. We have 29. We reduced a lot of our CDs that we had because we're pushing more into municipal bonds, but we're still doing a lot with our local banks, money market accounts, government pools. You can just see that it's a lot more diversified than it was previously. And then this is our result. You can see the income level. I took over in 2017. The income's just gone through the roof. We are now earning over $1 million a month on our investments. And what that means, to county boards or the taxpayers, that's money we don't have to rely on property taxes to fund our budget. It's almost like free money. And if we had continued doing things the way we had in the past and had to make these changes, we'd be earning about half of what we're earning right now. So it's been very good. I mean, our county government has frozen its tax levy for 7 straight years now. We have not increased it, and we're still able to fund everything. We haven't had to lay off employees. We're just very well positioned. And this has helped allow our county board to do that because, when you're this year, we're going to take in at the end of this fiscal year, Now that when I update this, it'll be right at a little over $10 million. Next year, we're projected to bring in over $12 million. And that's all money that, in my opinion, like this basically offsets property tax, needs. So that's why it's important to make sure that you're really taking advantage of opportunities with your portfolio. And like I said, if it's not something that you're willing or able or capable of doing on your own, there's nothing wrong with that, because we all have our talents. But make sure that you're looking at other opportunities and maybe interviewing firms that could help you manage that, because you're just really, really leaving a lot of money on the table. So there we are. So we have 31 million investment income since 2017 when we took over. I think the previous 6 years they brought in 4.5 million. So it's a drastic difference. We're talking about almost 8 times as much. Plenty of liquidity to meet our needs, for this. And then we're protected to hold up well if the interest rates decline. So not everybody's got a portfolio this size. There's probably, maybe a dozen counties that do, but it doesn't matter. This is all scalable. It doesn't matter how big or small your county is or how much money you have or don't have. All of these things are capable. It's all scalable. Whether you have a $2 million portfolio or a $200 million portfolio, you can take advantage of these things. And so I'm going to turn it over to Staci right now. I hope I didn't overwhelm everyone too much with all that information. But we will take questions at the end, and I'm always available for questions anytime if you give me a call. So, Staci, I'm going to turn it over to you.
Okay, thank you, Chris. Good morning, everyone. Again, my name is Staci Mayall. I want to thank Laura and Nancy for pulling this together, and those of you who are joining us on the webinar today. So earlier, Chris had talked about basically when you're looking at investments and being custodian of county dollars, there's the simple version, and then there is the Slusser and some of my other colleagues' version. So what I wanted to do is provide just a real brief snapshot on what I do here in Fulton County. You can see I have a comp of cash and investments that was done a few days ago. Fulton County has approximately 49 million in assets. I have only about 10% of that in CDs, and about 40% of that is with local banks. So the way I have mine structured is I'm about 50% with funds in local banks and 50% in government pools. So when I talk about that local bank relationship, in our county, we feel it's really, really important to have a good working relationship with local banks. They not only are part of our community, they live in our community, they contribute to our community, they also are part of the tax collection process. Many of those banks are collector banks for us. They're providing a service to my constituents, and those accounts that we have with them are not always in deposit continuous form. So about a third of the year, a lot of those accounts may be dormant. So it's important to me and a lot of my colleagues that we do have a working relationship and we do have deposits with those local banks. On the flip side of that, government pools, as Chris had mentioned earlier, is where it's at for interest rates right now. I did a quick look. Illinois funds is the monthly average is about 5.5%. And PFM, their Illinois Trust, is about that same, 5.45 is their 7-day yield right now. So within the Illinois Trust or the PFM accounts, I do have some time deposits. So Chris, without kind of reiterating everything that he said, we do have a lot of, it appears on paper that everything is liquid, but within the government pools, PFM, I meant in that you can do time deposits or CDs with them. So I have that same, past analysis that I have done, meeting with department heads, finding out what their needs are financially and when they're going to need certain amounts, and then structuring our portfolio to match with the day-to-day operation needs of the county, and also trying to optimize what that interest looks like. And again, not to reiterate what Chris said, having those relationships with the local banks are very important. When we started to see an uptick in increase in interest rates, I sat down and requested meetings with the presidents or leaderships of those community banks and just started talking about those interest rates and recognizing that they have shareholders, they have people, they need to be profitable. we also, as county treasurers, need to be good stewards of property tax or sales tax, and just taxpayers' dollars is the best way to put it. So none of us like to be told no, but if we don't ask, there's not going to be any type of bridging of meeting what the needs are with the bank and also the county. So whether you're a city or county or anybody else that is sitting on this call, one of the best practices and take away from the webinar is don't be afraid to ask. Don't be afraid to go out there and chase better interest rates, because they want to retain that business. They want to retain that deposit relationship. And I went from getting 0.2, 0.3% to saying, I really like to see a 4 and nothing below it. And fortunately, I didn't get told no. And it definitely has a positive impact on what your investment portfolio or even just operating cash portfolio looks like. So Chris, if you'll advance to the next slide, please. So the best topic, what everybody loves to hear about, is statutes. So earlier, Chris had talked about the different responsibilities some county treasurers have. And one thing is that we all wear multiple hats of responsibilities, but we are elected to serve as a county treasurer / collector. So where a lot of our responsibilities are defined in state statute is Chapter 55 in County Code. That is what I'm going to go over today. That is what this webinar is focused on. That other hat that we wear is the property tax code. That's found in Chapter 35 of the state statute under the, again, property tax code. If you're looking for a really good, interesting read, I encourage you to do a deep dive in both of the statutes. Next slide, please. So a bit of those differences that we had talked about, the treasurer, collector, some of us serve as CFO, some of us are in charge of the accounting, some of us are in charge of payroll. I happen to be the authorized agent for our pension plan as well. Some of us wear multiple hats, but regardless of the responsibilities we have, the statutes are going to define to us as county treasurers what we are responsible for. So for the sake of time today, I just selected 5 statutes that kind of speak to a little bit of the functionality or responsibilities that county treasurers have. The first one that I want to highlight is about our function, powers, and duties. So what this one is basically saying is it has he, but I'm going to say he or she, shall receive and safely keep the revenues and other public monies of the county and all of the money and funds authorized by law to be paid to him or her, and disperse the same pursuant to the law. So again, basically, whether you are responsible for doing the accounting side of it or not, the county treasurer's office is where the revenue is deposited into the county. We are the custodians of the county funds, and I'll get into that a little bit more in a little bit here. So also, like any of the other elected officials, we shall appoint our deputies, assistants, and personnel, and we are responsible for the employees that we have. And that we also, any of our functions and powers is in uniformity with the various counties across the state. Side note, here in Fulton County, my team are rock stars. Next slide, please. So the next one is dealing with the internal operations of our office. And the internal operations of the office, the treasurer shall control our operations, any of the day-to-day operations, and also procure the necessary equipment, materials, and services to perform those duties. I thought it was important to define that today, and that, and this doesn't go just for county treasurers, it's the other elected officials as well, but today our lens is through a county treasurer. And that is where our budget comes into place, and the board is going to approve a budget, an operating budget for county treasurers. And then it is our responsibility to spend those dollars accordingly in terms of controlling the day-to-day internal operations of our office. Another thing in terms of a best practice, it's very important that whether you have a staff that is union or non-union, you have a personnel manual that guides what those rules are and policies and procedures. It's important to have internal controls of your office and defined, and not only internal controls and define those in policy and procedure, provide those to your staff and have your staff sign off on acknowledging what those expectations are. So when things go wrong, you have a good mechanism of defining what those met or unmet expectations are, and also for fraud prevention. When an outside auditor is going to come in, they're always going to interview you on what those internal controls are. Whether you have a very small county and there's only a few of us, or a large county and you have a lot of staff, it is best to, just like with investments, don't put all your eggs in one basket. Diversify those responsibilities, and also what everybody is doing in the office, not only for efficiency, productivity, but also to help eliminate or deter from any potential fraud. Because remember, all revenue is coming into the treasurer's office. Next slide, please. The deposits of funds. So basically, this is a whole lot of words, and I'm not going to read hardly any of this to you. What this basically is saying is that the county treasurer is going to designate with banks, credit unions, where those monies are going to be deposited. Now, the board can definitely provide some input, some direction, but at the end of the day, the way the statute is defining it is the county treasurers are custodian of the county funds. Another takeaway from this slide is at the bottom in section B, where we as county treasurers are in control and authorized to invest the funds based on the Public Funds Investment Act. And Chris had mentioned that statute earlier. Next slide, please. This next part is about keeping of the books. Now, this looks a little bit different in some counties, whereas Chris had already said that he has an elected county auditor. So his office may not be doing the accounting per se, but still with every county treasurer, that revenue is coming in. And so I'm going to speak to today in terms of the lens of how we do it here in Fulton County. We not only receive all of the revenue, custodian of all of the funds, we also take care of all of the accounting and financial reports and everything with the office. One thing that I do think is kind of interesting is it talks about that we state what kind of revenue we have received, whether typically it's cash, check, credit card. The statute says whether we receive it in gold, silver, and etc. I've never received anything in gold and silver. I think it would be really interesting, but please don't cast that out to the universe because my accounting software doesn't account for gold and silver. So, but it kind of shows a little bit how these statutes can be dated, that we do have, whatever guidelines and rules to follow, that we may receive revenue in gold and silver. My theme of the day is best practice. So with this statute, the takeaway is it's very important that that revenue that is coming in every day, the treasurer's office is depositing that revenue, getting into the bank. Whether we have really good interest that we're trying to optimize or whether not, I guess you don't want to have a whole bunch of cash. You don't want to have checks. You don't want to have things that aren't being deposited sitting in the bank. That's the safest place for them. So deposit daily, do the accounting work daily, balance out whether it is a one person's responsibility or several people share that responsibility. It is important that not only those deposits are daily, the accounting work is daily. That way you can find discrepancies if you are not balanced. And finally, monthly balancing in the accounting software. Most treasurers, there are 102 counties, which means there's 102 county treasurers. There's 102 different ways to do things. But many of us share very similar accounting software that we use. Our vendors may be different, but it's important to have fund accounting software and not just using Excel, for example. That way it optimizes your work performance and also the governance of the day-to-day operations of your office. One final note that I have with this is bank reconciliations monthly, if not twice a month. Depending on how busy we are, I ask my chief deputy in the middle of the month. We do a full reconciliation of those 2 weeks. And then obviously at the end of the month, once we have the bank statements for interest earned, the beginning of next month, we do a complete monthly reconciliation. I always want to find, because we're human, people make mistakes. There's errors in different things. Those are easier to be caught if you're more on top of things. They don't feel like you have to go above and beyond. Minimally monthly reconciliation in your accounting software and of your bank accounts is super important. Next slide, please. And finally, the last statute I want to talk about, and this is kind of ties into what I was talking about with that with the monthly reconciliation. Every county treasurer shall provide a report to the county board that basically is where we are at on things. Earlier, I talked about how the county board sets a budget. That is one of the responsibilities of a county board as a governing body. If you're a municipality that's on this call, it's going to be your city council. Regardless, there is a governing body of each of the institutions or county local government that we're speaking about today. So they set the budget, but the treasurers are responsible for the reports that show where we are financially. So what those actuals have been spent, what has come in actually realized monthly and annually, with revenue, with expenditures, where we are with our cash assets, where we are with our investments. And some county boards may be structured a little different, or some counties may have commissioners where you want to see something different. A lot of us, again, use accounting software that's provided reports to us. I would encourage, if we have some board members or council members or somebody that are on this call, if you're seeing something in a report and you would like to see more or something different, just reach out to your county treasurer, reach out to the treasurer, whatever organization you're with, and see if there can be some flexibility on that. You know, we kind of get set in our ways as humans. We're habitual in our nature, but that doesn't mean that just because one certain report is being provided every month, that you're not able to look at things through a different lens. Without speaking on behalf of all 102 county treasurers saying that they're going to do it, again, this is just a best practice and a way to facilitate some good collaboration and correspondence between a treasurer and the governing body. So in conclusion, I kind of very quickly went through some best practices and also some of the statutes. I recognize that I was kind of being a little honorary or facetious earlier when I encouraged you to do a deep dive in state statutes, that it's not fun reading per se, but it truly is the guidance in terms of elected county treasurers and collectors on what we have to follow. There are many more statutes that we have that serve as a governance of how we are to do our job. I just kind of wanted to take a brief snapshot and do an overview of what some of those responsibilities and duties that we have. And also, again, tie into what a more simplistic version of investment means. Whether you have a small county or a large county, we do have a responsibility as custodian of the funds and of investing taxpayers' dollars. So at this time, I want to, on behalf of Chris and I, thank you all for joining us. And I believe we'll be going into a Q&A. Chris, if you want to put up, thank you very much. So we've included our contact information here, email, phone number. Feel free to reach out to us at any time. We are more than happy to help. And again, thank you. Laura's giving me the finger pause.
Laura, you're muted. Okay, it looks like Laura needs some help unmuting. Let's see if we can help out Laura and get the Q&A rolling. You should be good to go, Laura.
Thanks, Nancy. I think I wasn't listed as a co-host, so it wouldn't let me unmute myself. I was trying.
And that happens sometimes if there's like a spotty connection, it logs you out or something, and then I think you lose that. And yep, sorry, I didn't see that earlier.
It's all good. No, I didn't realize it till I tried to do it. Anyway, thank you, Staci and Chris, for all that great information. There's a couple of questions that have come in, so I'm going to start with the first one. And Chris, you may have addressed this, but I just want to make sure. So one of our participants said that they had received a recommendation from a board member with a sample investment policy, and they were wondering if you have a sample investment policy, and if so, you'd be willing to share that.
Yes, that's actually something that I should have mentioned on the presentation. I skipped right over it. But yes, we're required by statute in the Public Funds Investment Act to have an investment policy. And it lays out what needs to be included in that policy in the Public Funds Investment Act. There's a specific section for it. But yes, I have one. Now, mine may not work for everyone else, or, depending on the county. But what I did actually, when I put mine together, is I kind of cherry picked from a lot of different policies that I liked. I remember the Will County Treasurer at the time had some really interesting things in there that I thought would work for me. And then, I borrowed from several other treasurers. But yeah, mine is actually out on our website. And but I'm also happy to email that out as well. And the other thing is, you can change that policy anytime you need to fit your needs. I think I've changed mine about 7 times since I've been 7 years. I haven't changed it in a couple of years now, but I had it too restrictive. And so I wanted to add some investments that weren't permitted in my policy. So I just changed the policy. And as long as it's in, it conforms with the Public Funds Investment Act, you can do that. Actually, I've seen some treasurers basically just say all investments permitted under the Public Funds Investment Act, and which is probably a better way to do it. That's probably what I should do with mine at some point. But yeah, I'm happy to share that.
Thanks. And Chris, if you don't mind to send that to Nancy, she could probably send that out with the follow-up after the webinar. That would be great.
Sure.
Or at least a link to where it's at on your website, if you don't mind.
Yeah, no problem at all.
Okay. So what indicators or numbers from reports should the average citizen be looking at? I'll open that up to either of you. What do you think, if you're putting reports out, what do you think that the average person would be interested in?
Chris, do you want me to start?
Go ahead.
Okay. In terms of the financial reports, I think it's important to look at what has been budgeted, what has been appropriated for revenue and expenditures, and then look at the actuals, what is actually received in revenue and expenditures. And are people going over budget? Are people on target? Depending on where you are in the fiscal year, are you on target to meet said revenues or to exceed expenditures? That is something that I am continuously looking at, working with department heads to quote unquote clean up the budget. But it also helps, and I do an overlay for cash flow analysis. If it looks like they haven't spent a whole lot of their budget, why? What are their needs? And is that going to come at the end of the fiscal year? But the lens of somebody from the public looking, I think one of the first things is, and what's very transparent in all counties, is what do those financial reports say in terms of budgeted revenue and expenditures, and what is actually realized revenue, expenditures, and expenses.
Chris, anything to add to that?
No, I think that's good, because our county auditor, I know when we get our annual CAFR report, the annual financial statement, our audited financial report, the county board and the finance committee, typically they have no questions to ask. And that's common, because that document is very overwhelming. It's a very big document. Our auditor, he's a younger guy and he's a little more dynamic, and he highlights certain areas that he encourages them to read, like, hey, read these 2 pages here. If you don't do anything else, read these 2 pages. And I think you should be talking to your treasurer, or if you're a county board member or a village board member or city council member, you need to be talking to your treasurer, or if you have an auditor, your auditor, ask them, what should I be asking? Because I joke sometimes, but joking and not joking, sometimes I feel like I could tell my board anything in those meetings and they would just take it as the gospel and not question it. And as treasurers, I mean, I guess I should speak for myself, but I like to be questioned. I like it when they have questions in meetings. I like it when they say, I don't understand this. Why did you do this? Because it gives me an opportunity to lay out why we did it that way and help them get a better understanding. But so if you're a board member and you don't know what questions to ask in a meeting, just because you're overwhelmed by financial statements, talk to your treasurer and nail down the highlights, the things you really need to be focused on. So that way, you're better educated and you can ask better questions in those meetings.
So how are county priorities reflected in the county budgets?
I think the priority is reflected in the county budget, first and foremost, the employees. Personnel, when you look at a county budget, basically the top expenditure is personnel. And it's important to invest in the employees. Now, that is not only salaries, but what those benefits look like. So when you're looking at a county budget and looking at a priority, and this, again, we keep saying county because that's our lens as county treasurers, but whether it's a village or, a city, anything like that, typically personnel is one of the largest expenses that you have. And it should be, because again, investing in the employees that are there for the day-to-day operations. You may also see in a budget where infrastructure, build out capital improvements, you're going to be able to see that in a budget if that is important as well. Chris, do you have anything to add?
I would agree with that. And a very simple way of putting it, I always say your checkbook always says where your heart is, and so and on a personal level and in a company or a government body. So, our county, obviously, I think anybody's budget, personnel is going to be, and payroll is going to be a big chunk of the budget. And in our county, I know we've had a really strong focus on law enforcement in the last several years. So you've seen our sheriff and our state's attorney's budgets go up significantly, and because that's been a very strong priority of our county board. So, yep.
So we have a very interesting question that I'll throw out there. I don't know what, but I'll be interested to hear your answers. Do you have any suggestions on how to increase county revenue so potential staff layoffs can be avoided?
Oh, that's heavy.
Mm-hmm.
That's heavy. Okay. Love for Chris and I to be put on the spot, because that sounds like we're going to wave a magic wand and make things. Okay. So to recap, the question is what we can be done to increase revenue to prevent layoffs. So first and foremost, look at the investments. Chris already showed and proved that when you focus on the investing and getting that interest, your rate of return, you can offset. Now, I wouldn't count on investments for paying for personnel. It's too high of an expense. You can, different fee structures. Some counties will go through and have a study done on what the fee structure is and an overlay of statute to see. A lot of statutes may say up to a certain amount, and a county may not be charging up to a certain amount, for example, recording or for treasurers in our automation when we sell a delinquent parcel. So looking at a fee structure, the Safety Acts, don't even want to go there today, not our wheelhouse, and what that may do with revenue. That is a tricky question. And I think that is definitely specific to each county, each city, and what those needs are. I know that wasn't a very helpful answer. Chris, maybe come behind and, and save me.
Well, I mean, in the immediate term, it's really hard because, the only way you really can do it is through some sort of tax increase, I think, or fee increase. But I think it's more of a longer term thing, and it has to be a combination of economic development. The fee structure, I think, is important. We tried to implement, we haven't raised our property tax levy in a long time here, but we have raised some fees like user fees that are specific to users that we didn't think that all the other taxpayers ought to have to pay for if they're not utilizing these services, or, a vast majority of the people aren't utilizing them. But also just automation has to be part of it and getting things more efficient. And we have done a lot of that in our office. One of the things we've tried to do here, just in our office, is we've really tried to push people into receiving their tax bills electronically, because we spend so much money. We're required to mail those bills unless someone opts out of it to get have it emailed. But it's really hard to get people to do that. And I send out 135,000 tax bills, And you would think we have enough people who would, that are on escrow that don't even need a tax bill, a paper bill, because their mortgage company pays it. But it's hard to get the public to take advantage of some of those things, even though they know that it can save us money. But I don't know, I'm getting long-winded here, but I think it's really, there's really no good short-term answer, other than just getting lean and mean and with your budget, but then also having a long-term plan. Because I know there are some counties I talk to, they're in deep trouble financially. There have been COVID, the ARPA money kind of bailed some of them out. But unless some longer term vision and some plans are put in place, you're probably going to end up in the same spot you were before. So
yeah, and one other thing I'd like to add is, you focus on increasing the revenue because of potential layoffs with that expense. And a lot of times we look at budgets and we look at a raise and it's just that year. But I encourage my county board and other counties, look at it long term. When you are looking at raises, is that sustainable financially? What does that snapshot look like in the next 5 years? Revenue it's a bit difficult to predict, whereas expenditures, what your top expense is, and trying to project that out in terms of personnel. Nobody likes layoffs. Nobody wants to lose anybody. I have, in order to try to help our county through attrition, I have reduced my office staff. It was painful, but it was the right way because somebody was retiring. And so I replaced a full-time position with a part-time position, and then took a part-time position and made it a seasonal part-time position. And it may or may not work in every case, but I think the biggest thing to take away is just keep an open mind and have open communication on what the needs are and what the priorities are, and then find a compromise. At the end of the day, it's a compromise.
We're getting close to the noon hour, and I know some folks may have to jump off, so I'm just going to ask Nancy if she wants to put the poll question up at any point. We're welcome to do that, but I think our presenters are willing to stick around to answer a few more questions, so we'll keep going, but know that we may lose a few people here at the noon hour. Can the municipality request financial assistance from the federal government to cover the cost of employment?
not that I'm aware of.
Not that I am aware of too. And a lot of times with the grants and different things that you can get from federal or state government, a lot of times personnel is not something that's listed in that. It's infrastructure, it's several different things, but most assistance, especially grants, it's hyper specific on how those dollars can be spent. And you have to track it, you have to report back, whether it's a reimbursable expense or any of that. But personnel is a tricky thing that typically is not covered by federal or state funding.
Chris, there's a couple of questions specific for you. So it says you currently have almost 300 million in investments for a population of 245,000. That's really impressive. How long did it take you to work with departments and county board to get these funds invested? And was ARPA funds a big contributor to funds to be invested?
Well, since we deposit all the money, we actually, I invest all the money and I don't really have to go get permission from, because the Public Funds Investment Act, it gives us, their state statute gives the treasurer authority to go invest the money as long as we're following the guidelines. And so, the county board and then the department heads, they've been thrilled because every investment report I've given over the last several years has been better, which means more revenue for their funds. So that part has been pretty easy. And, like I said, it's like good news every time we have a report. Thankfully we haven't had any big downturns. But what was the other part of that question that I answered?
Did ARPA funds, were they a big contributor to how much you had to invest?
Yes. So currently, I think of the $51 million we received in ARPA, I think we have about 43 or 44 million left. So we're earning about, $2 to $2.5 million in interest a year on that money. And that money can go into our general fund. It doesn't have to be earmarked for ARPA projects, which is nice. So that part has helped for sure.
So as a follow-up to that, I'm going to throw another question out to both of you that like what off the top of your head, what's like projects maybe that your county board has approved or for ARPA that you know is going to sit there for a little bit and be able to earn money. We realize the money has to be spent within the next few years, but you know it's not going to be spent this year or the next 6 months. Like what's some of those projects that are able to sit there and help you earn that money a little bit more?
You want to go first, Staci?
I'll let you.
Okay. So the vast majority of our money that we received in our county, we used a little bit of money for some IT security upgrades. There's a few infrastructure things that we did in-house, but the vast majority of that 51 million, we are using to partner with local municipalities on infrastructure projects. Municipality might have gotten $2 million in ARPA funds, but they had a $5 million project. So some of them are pledging all of their 2 million towards that project. And then we come in with the $3 million to match. And so we're kind of at the mercy of some of the municipalities to get these projects going. They're also, I talk to municipalities all over, this county and different parts of the state, and they're having a really difficult time getting bidders because the workforce is so thin right now, and contractors are struggling to find help, and they're completely maxed out on their projects. The other issue that I hear, some of the members on the IMET board that I serve on, they're all in the Cook County suburbs, except for another woman from Champaign, but they're all city finance directors and city managers, and they talk about the costs of these projects are coming in like 40% higher than what they expected. And so, because material costs are high and labor costs are a little high, because these contractors, if they have, more jobs to bid than they can handle, they're going to bid high. And so their thoughts are, if we wait a couple of years, we can still spend the money and maybe some of these costs will come down a little bit. The workforce will loosen up a little bit, and these, there are more people bidding. So that's what I'm seeing. There's a lot of ARPA money nationwide that has not been spent, but in our county especially, like I said, we had 51 million, and I think we've only spent about 7 so far. But most of them are infrastructure projects, to answer your question.
Yeah. In Fulton County, one of the first things we did was help take care of small businesses. We did a sizable amount for small business grants. And like Madison County, Fulton County is also giving a good portion and back into community projects, whether it is other small government or any communities that need stuff. So that money has been kind of sitting there. We've had some money go out the door. Our big ticket item is infrastructure for a new building for our highway. So quite a bit of the ARPA money that was earmarked for that I have termed out. I have been working with our highway engineer on cash flow analysis and when he's going to need that. But Chris is right that, some counties have plowed through that money, but quite a few counties are sitting on it because so many projects have been earmarked for infrastructure improvements, and the cost of materials right now and the lack of labor is causing those to have a delay, which, while interest rates are remarkably high right now, it's kind of a win-win because the county is going to be able to use that interest and designate it in county gen however they see fit.
Another comment. Chris mentioned the concept of department heads spending down their budget at the end of the year to be sure they get that amount next year. What incentives do you have to get them to spend only what's needed rather than buying future supplies and equipment just to empty their account?
Okay, so what we do here is we have a policy where you can reappropriate up to 50% of your leftover funds into next year's budget. So, because they're every now and then they're, and that's just a general, the county board will approve larger reappropriations too. Like there was, there may be a highway project that didn't get done and they had to, because of weather or labor, and they had to move it a year. We had a settlement that I inherited when I came into the office where we ended up having to pay out a settlement amount. And so I was able to reappropriate funds that we didn't use the previous year to pay that settlement agreement. So, those are the kind of things we do is I think is a fair way of looking at it is, we'll reappropriate up to 50% of your leftover funds. And I don't know, it's probably not a perfect strategy, but we also, we're constantly, our county board does a pretty good job, the finance committee and one of our administrators, of just reviewing on a monthly basis where we're at with our spending. So.
And Chris, someone's wondering if you're willing to provide names of the investment consultants that you work with.
Yes, absolutely.
Okay.
Yep. Yeah. So I think it was in the slide presentation, North Shore Private Asset Management is a group out of Lake County that I use. Not trying to do a commercial for them. They are good, but if you do an RFP, they'd have to win your business. But there are other good firms that bid that I would have been very comfortable using. There are a few that I would not be comfortable using, but I'm happy to go offline and talk with anyone that wants to call me or email, and we can discuss that. Perfect.
We've gotten through our questions. This was a great presentation. We really appreciate both of your time. Thanks for sharing this. I think, you know, if folks don't work in county government or maybe city government, municipality, you know, and don't work in those kind of local government roles, I think a lot of this is not something they're familiar with. So I think that's really helpful to a lot of folks. So thank you again for your time. Thanks again to Extension for co-hosting these webinar series with Rural Partners. We hope everyone has a great day, and we look forward to you joining us at a future webinar. Thank you.
Thanks for having us.
Thank you.